Bank Nifty in a sense is crucial. Why? Because for the Bank Nifty, numbers have not been bad, whether it's ICICI Bank or HDFC Bank. The big boys are clearly indicating that things are not bad. And if things are not bad for the big boys, then the sector per se will get a lot of support from some of these large private banks or maybe one or two PSU banks also. But for IDFC Bank, and V. Vaidyanathan would be joining us in moments from now, we do have a situation where the microfinance book has not stabilized. And that is something which in a sense could be a challenge, or this is something where they have been really upfront in terms of recording, in terms of really recognizing their entire microfinance stress. V. Vaidyanathan, Managing Director and CEO of IDFC Bank, joins us now. Mr. Vaidyanathan, good morning. Thank you for joining us. Let's begin with the profitability for the quarter gone by. MFI stress across industry is evident. Has that impacted your bank as well? Because now decisively your exposure in the MFSI space has come down to 5%. Provisions were high in last quarter as well and even this quarter. What has impacted profitability and what should one expect from here?
See, the MFI is usually a 2-year loan. So the impact of this MFI doesn't last too long. On an incremental basis, the industry has come together and put together some new norms or new controls under which the new loans are getting booked. So incremental will be, as per the industry, it should be fine. So as far as the existing book is concerned, our gross NPA has peaked to 4.5%. SMA also has increased to 4.5%. We think that this quarter, that is Q4 FY25, we should see our own assessment at this point of time is that we should see the peak of it. And then Q1 26 should be, our provision should be less than Q4 25. And then every quarter after that, it should come down. That's our assessment at this point of time. But this is an industry we should be very careful about and watch it closely. Our analysis today is taking us there.
So you have been slowing down the MFSI growth, and this is largely impacting your NIMs also because, for the viewers, I must establish that the MFI NIMs are the highest. So is there an ideal range where you think that the comfort in terms of the MFI exposure for the bank? Because even if there is stress, the segment also brings incredible NIMs.
Not only net interest margin, this segment has multiple benefits actually. One, it helps us meet the weaker section private sector loans, and it also helps us meet, of course, get net interest income. It's also quite profitable. If something has been very profitable for a long period of time, if it goes through a lean patch, we should accept it in its entirety across cycles. So that's how we think about it. Even going forward, once the industry cleans itself out, then we want to participate with the rest of the industry. But we believe that by next year, that is by 26 March, which is 1 year from now, we think our MFI book should be around 3 to 3.5%.
So as per your guidance, you aim to bring the cost to income ratio at 65% by Q4 FY25. Currently it is 71. Do you think the next quarter you can achieve this guidance, and what are the key changes you're likely to make in order to achieve this?
See, as far as cost-to-income ratio is concerned, we are running behind in the sense that it's higher than what we anticipated or what we guided. And we agree with that and we admit that. The thing is that this bank had to be built. To an extent, the cost-to-income ratio also a little elevated because the microfinance business is slowing down and the income from that line is also missing. When you say cost divided by income, the income line itself got a little affected. So that affected a little. But having said that, there was really no choice. We could not have not put, branches. We could not have put the ATMs. We could not have put the technology that was required. We launched so many lines of businesses like cash management, wealth management, and they're all, fantastic businesses for the long run for the bank. So, and of course, the liability side investments, credit cards. So all of these are important investments for the bank. They will all pay back. Every business is built for profitability, and every business, as they scale up over the next 4-5 years, definitely cost-income ratio will come down. We are very clear about it. Cost-income ratio should come down, will come down. It is just a phase when we are investing, and I really believe investment is important.
NIMs are in a downward trajectory, yet much higher than guidance. What are the levers to keep the NIMs afloat above 6%? And could this also start normalizing towards the guided range?
Well, give or take, we should be somewhere in the zone. Ours is a very unique model in the system because we have developed a specialization over 15 years of being able to, lend, at a slightly higher yield than the rest of the market because of the product mix we have. Our products are basically higher margin products. That's how our business is. And more importantly, our credit cost is very controlled. That's very important. Just having net interest margin or a high net interest margin does not solve a problem, right? That has to be accompanied with low credit cost. It's been a very, very long time. Our credit cost is very tightly controlled. It's quite low in the context of a net interest margin. So if you see, even this quarter, our credit cost is, excluding MFI, is quite low. So so that's a very unique combination our bank has.
So your loan book consistently is above 20% for last 2 years. You aspire to achieve a 50 crore loan book by FY29, which is actually 2x from here. How do you see the growth curve in coming quarters then?
We think that we'll talk both the loan book. The loan book, certainly we feel confident that about a 20% growth is what we've guided. Actually, even if we did 20, 20, 24 for 4 years, we will reach a guidance of about 5 lakh crores. We are personally, we feel that really delivering 20% growth in this country on a low base we are starting is not at all difficult. We have the really good capabilities for that. So really 20% growth should be quite possible. We'll deliver it this year also in FY26, 25. We'll deliver in FY26 also. But more importantly, as you know, it's not the growth of 20%. That's not difficult. We are very particular about asset quality, and we're quite confident our excluding MFI, which will go away in due course, excluding MFI, the rest of the book, we want to keep good asset quality along with 20% growth.
So will you give up some margins required to achieve that growth, or will margins be prioritized? I mean, the reason why I'm asking you this, Mr. Vaidyanathan, is that in this quarter, the bank managed to grow its wholesale book, which impacted your margins which impacted your NIMs or margins as per the management.
See, we have to see this in totality about what is the final profit of the bank. In the wholesale book also, of course, we are growing the wholesale book in a very measured way, in a profitable way. And I must share with you, again, I talk asset quality when we talk growth all the time. It's been 5.5, 6 years since the merger. There is not a one loan of wholesale loan, done that has actually gone bad. I mean, we disbursed close to about 40,000 crores or thereabouts. There is no NPA. So that's a good quality book. Now, that book, to your question about net interest margin, of course, comes at a lower margin. But to the bottom line, we are seeing that adds a lot because operating cost is quite low.
So deposit growth also has been remarkable, 30% consistently. You also aim to achieve a 50% CASA within these deposits. What strategies are you implementing to bring CASA growth from here on?
See, the deposits, our key focus is service. And that's like super important. From day one of the bank, we took this positioning that customer service is going to be definers. I think most customers who experience us, they do express that our service levels are very good. Our app is very good. Our technology is really first rate. There are many applications we're giving to customers along with the regular app. Branches are very, this one culture. So deposits is very much a service culture business. And we are determined to keep on improving our service levels. And that will be a key strategy.
CD ratio is now below 100%. Any target for the CD ratio, where it is headed? And where do you find comfort in terms of the growth and the yield balance?
On the CD ratio, look, it's been like 6 years. I'm really happy to share with you that our bank has had very, very, very strong success in raising deposits. You said the number, like about 29% is the deposit growth this year. Our assessment is that our incremental credit deposit ratio for the bank has been in the order of magnitude of 75-76% only, which means incrementally last 5 years, our CD ratio has been about just that much, quite low, which is really very good. And that is fixing the base. So you already come to the mid, 90s. It'll keep coming down from here. It'll keep coming down. It'll go down to the 80s. It's by the way, let me remind you, it was 165 or 169%, including corporate bond investments in 2019. From 165 to come down to below 100 is really a really safe practice.
You also mentioned the CGFMU cover and can provide potential recoveries of 70% by FY27. For the interest of our viewers, tell us a bit more about it, and this support the MFI stress pool in coming quarters, or how can it support the current stress that is there in the segment?
See, in the MFI business, there is a timing difference between when the insurance company pays and when the loan becomes 90 DPD on our books. So on our books, 90 DPD, we take 75% provisions straight away. We are not waiting for the insurance money to come back. So we take it upfront, and then by 120 days past due, we take 100%. So our provisioning policy is really very, let me say, conservative, if I put it like that. So that causes a little more of upfront provisions, but the insurance company's payment of this will come to the extent it's insured. It's 58% insured. To that will come somewhere with a gap. There is a policy laid out that they will wait for 1 year, which means we'll see it in 2027. So that will come back when it comes back. But we are focused on keeping our books clean as of now. When it comes back in 27, it will be it's just an addition to income. We actually feel, you talked of cost to income ratio. I told you we invested in so many things. Actually, we think of it like investment. We don't see the cost to income ratio. Actually, the way we think about this investment. Everything's an investment. And we believe that investments will pay back in, by let me say by Q3, Q4 of next year, you will start seeing the improvement. And in 27, of course, we will get to see a solid increase. It just takes time for all of you who are observing this, but that's the way nature of business is. It takes time for investments to show up in this, to show up as profits in this business. And it's only been 6 years since the merger. Setting up a bank takes decades. Setting up a good bank, good quality, good culture, universal bank, all products, it takes, like we said, taking a decade, and maybe only 6 months in the journey. In the next 4 years, we will definitely deliver.
All right, Mr. Vaidyanathan, good luck, and thank you very much, and have a wonderful quarter ahead.
If you like this video, then like, share and subscribe to ET Now.